We've had housing bubbles before, quite a few, and other kinds of asset bubbles before,
Right.
most recently an oil price asset bubble. This one was really quite special. I want to press you a little bit on this because I'd like to get your sense of why this one was special. Why did it get so large? Why did someone with your astute knowledge about the economy not see that this was an extraordinarily different bubble from one we've had before?
Well, I wish I could give you a good answer to that. It was really the granddaddy of all bubbles, and it affected an asset class of 22 trillion. You know, I mean, it hit everybody, and Mr. McDaniel mentioned people refinancing. I mean, they were betting on the fact that the following year that they couldn't make the payments, they could refinance, and of course the figures show that by the hundreds and hundreds of billions that happened. But when it gathers momentum, the internet bubble went further than I would have thought it would have. We did have that farm bubble in Nebraska where
Right.
Things went crazy for a while, and the early Cassandras do look kind of foolish as they go along. And when your next door neighbor is making money, very easy by buying a second house, with very small down payment, after a while it sort of gets to you, and maybe you figure you should be doing it too. It's been a history of bubbles. I mean, I never understood why tulips were worth what they were back in Netherlands.
But for you in particular, and you've had many years to watch our economy, and to economists in general, sharply rising prices are a signal that something is peculiarly going on in the economy.
Well,
you saw the prices rising very quickly, but you still didn't think that this was something that could eventually collapse.
I didn't think it would pop like it did. No, interestingly enough, in 2005 and 6, and I believe I've got the time period right, I get offered businesses for sale periodically. A significant percentage of the publicly traded home builders, one way or another, let it be known that they would like to sell out to Berkshire Hathaway. And looking back, I should have figured out what I didn't figure out.
Were they asking more than once?
It's interesting. I never heard from them. In many decades in business, and all of a sudden, 3 or 4 of them showed up on the doorstep.
You were once an owner of Freddie Mac.
Right.
So you are familiar with how Fannie Mae and Freddie Mac operate. Do you see their activities as having any role in the growth of this bubble?
Well, I think they were doing what they were instructed by Congress to do to a great degree, but they took on weaker forms of mortgages in greater amounts. I mean, that's been covered in some of the reports. And they also bought. They would require a 20% down payment, but then they would buy mortgage insurance from other entities. And I've looked at the profile of some of those loans and material I got from the mortgage guarantee organizations, and frequently, a significant percentage of the time, more than 50% of the income of the borrower was going to mortgage payments. That's not sustainable. But whereas they were laying that off with a mortgage guarantee insurance company, they were still, in effect, helping people participate in something that was really, unless housing prices kept going up, was going to lead to big trouble.
Why did you sell your Freddie Mac stock?
I sold it for several reasons, but I think we were the largest shareholders of Freddie Mac. And at one point, it became apparent they were getting more and more entranced by trying to report increased earnings every quarter. And any financial institution that tries to do that, in my view, is going to get in trouble sooner or later. And they became quite interested in that particular, having that happen. They also, at Freddie, as I remember, it was either RJR bonds or Philip Morris bonds, but they bought some bonds that had nothing to do with housing at all. And here they were using what was in effect the government's credit to enlarge the size of this hedge fund type portfolio, now with some corporate bonds that had nothing to do with housing. And I just figure if you see one cockroach, there's probably a lot more in the kitchen.
Did you follow Fannie and Freddie enough to know that they had affordable housing requirements?
Oh, sure, yeah.
And did you know the size of those affordable housing requirements?
Yeah, and of course, they were predicated on being able to use the tax credits that were involved, and they set them up as assets on their balance sheet, and of course they have no income now, so those became very dubious assets.
But were you aware then that they were buying the kinds of mortgages that they were buying in order to comply with the affordable housing requirements that they? Well,
I certainly knew they were. Yeah, they were they were mandated in many of their activities by Congress. No question about that. And they were also trying to serve Wall Street, and that's a tough balancing act.
How much time do I have left?
4 minutes and 51 seconds.
Okay. You are quite famous for saying, among other things, and this isn't the only thing you're famous for, but you said that credit default swaps are financial instruments of mass destruction, and yet it's recently come to light that you actually participate actively in that market.
Yeah, I think I actually said derivatives are financial potentially, and I think that used improperly, as they almost are certain to be, because of what they provide people to trade in them and what they provide in the way of increased leverage that's not obtainable in other ways, I think that they pose system-wide problems. And
what do you use them for?
I use them to make money. If I think they're mispriced, I buy them.
But these are credit default swaps or other kinds
of
derivatives?
No, we've never bought a credit default swap. We've sold credit default swaps.
Yes.
We sell
protection,
insurance.
You sell protection.
We sell insurance.
The protection side.
Yeah, we sell it on municipal bonds. We sell it, on corporates.
And then do you lay that off?
No.
You do not hedge that?
No, I never lay it off.
So you do...
we sell insurance.
This is much like what AIG did, right? They didn't
lay off. I don't think it's much like it. But we sell credit insurance. Now we sell auto insurance, and AIG sold auto insurance too. I mean...
Okay. All right, I have no further questions. Thanks very much.
Could I bring up one point in
Sure.
connection with it? Because it gets back to a point that was made earlier about the laws getting on the books and never getting changed. If you go back to the late 1920s, we had a bubble then. It was in stocks, and it was partly caused by extreme margin by people that really didn't know what they were doing, 10% margins. And they had commission hearings after that, and they decided that this was a societal problem. And Congress gave to the Federal Reserve the authority to regulate margins. And they said this is important. The Federal Reserve still has that authority, as I understand it, 70 plus years later. When we put in derivatives and total return swaps, at that point you could borrow 100% of what you own. And so we sit here with this system, and I've brought this up a half a dozen times, and sometimes with people in Congress, and I say, what in the world are we doing when we say the Federal Reserve should have margin requirements, which I believe now are 50%, and you can go and get a total return swap and borrow 100%, or you can buy S&P index futures with a tiny percentage down. I mean, it is something that should be addressed.
I thought maybe I misread this in the newspapers, but I thought your problem with some of the legislation that is going through had to do with the fact that you didn't want to put up the collateral, which substitutes for the margin.
In terms of contracts that were negotiated several years ago, there was one price for collateralized contracts and another price for uncollateralized. We simply, and incidentally, Coca-Cola, Anheuser-Busch, thousands of companies negotiated under that basis. We say if we're required to substitute an uncollateralized contract and make it a collateralized contract, before we send that money to Wall Street, we should get paid for the difference in those two types of contracts, because they are two different contracts, just like changing the price or changing the maturity. And there's a very significant difference in price. And not only we, but hundreds of end users would be required to send money to Wall Street firms, contrary to the contract they originally negotiated, and contrary to the price differential that existed between those two types of contracts.
So you don't have any objection to doing it in the future when you
no, not in the least. I don't even object to. I object to selling one kind of a contract and having changed into another kind of a contract without getting paid.
Okay, thank you.